Okay, ready. Thanks everyone for attending. This is Juan. I'm the CEO of Darwinix, and today I have the pleasure of telling you everything I know about the broker alphabet soup. Since there's relatively few of us today, I would very much like or enjoy to take your questions as we go along. So please feel free to put those on the chat, and I'll be very happy to go through them. Okay, well, so let's go for it. You're all forex traders. You've all checked out the different brokers, and presumably you've always heard all this broker alphabet soup before. And today's webinar is my best take at explaining to you how this whole thing works. So today we'll very briefly cover a bit of historical background to explain to you the currency market and how it is an over-the-counter market, or OTC, to get going on the alphabet soup. How the technology and the internet brought along the birth of retail trading and the growth of MetaTrader 4, the terminal that is most popular with most of us. And with the advent of mass access to the market, came the three different models that I'd like to explain to you today, which is the dealer model, the pure dealer model, the pure broker model, and the mixed model, or a broker-dealer model, as we'll see later. And I'll cover the implications that the different models may have for you, your trading performance, and also, very importantly, protecting your trading intellectual property. So the main focus of today will be the dealing desk, i.e. DD, and non-dealing desk, i.e. NDD soup, DMA, which stands for direct market access, and STP, which stands for straight through processing. Now, I like to be pretty frank in when I speak. Quite often, a lot of these terms are used with a fair amount of bullshit. So if at any point in time you have any question or you're not absolutely sure what I mean, as I said, please feel free, go ahead and ask, because the main purpose of today is for you to be clarified on these. More importantly, at the end of this, I'd like to give you some guidelines as to how regulation and most importantly, incentives, so understanding what the incentives are of the broker with which you're trading mean for you. And that, I would say, is a lot more important than believing in all these alphabet soup marketing that has become so popular. Okay, so with that in mind, let's go for it. Let's take first a bit of background on the over-the-counter currency market up to pretty much 1995, which is when the internet came along and changed the game. Now, for us at Darwinix, we have this vision that this is financial prehistory. This is when the dinosaurs still lived on currency Earth. And life was pretty simple back then. So basically, the only people who played in this market were the major banks, as you can see here, also the other commercial banks, which collectively are referred to as the interbank market. So they all traded with each other. Very importantly, there has never been a centralized interbank market. So what has been going on is that, say, UBS would close trades with Goldman Sachs. Goldman Sachs would then close trades with JP Morgan, and they then would also close trades with German national banks and Spanish savings banks and Chinese banks and so on. So it was a huge bilateral market where all these banks exchanged the different currencies together with governments and central banks. Now, because the market was already the biggest at the time before electronic communications and so on were invented, there never was really a need for a centralized clearing model like you have, for instance, equities. With equities, what happens when you go to the New York Stock Exchange, everybody trades with a New York Stock Exchange that acts as the central counterparty. In currencies, currencies are an over-the-counter market, which is another way of saying that everyone trades with each other bilaterally. There is no central counterparty. And then somewhat outside of this, on the left-hand side, we had that society, meaning companies who needed to access to exchange currencies. And the persons, whenever we went abroad, you basically had to buy some currency to be able to pay for stuff, but you were essentially shut out of that. So, this is the dinosaur phase of history. then the internet came along and things changed radically because all of a sudden, the stuff that you could only do by working for a bank, which was that if you wanted to trade currencies before the internet, you had to work for a bank. That was pretty much the only way to do it, unless you were a very high net worth individual who could basically get his bank to do it directly for him. But that was it. You couldn't, as we do today, you couldn't send a trade for $10,000 to the interbank market because there just wasn't the technology, and everything was designed to process much, much larger trades. Now, as I said, the internet came along, the opportunity to trade the market was born with many platforms, out of which emerged MT4, and independent traders like us were suddenly in a position to basically try to make a profit by guessing where the currency market was going, and also take some leverage in the process, which allowed us to amplify our gains and losses. And with all this change was born the broker Alphabet 2 that we're going to discuss today. Now, just to give you an idea of how fast things have changed, I mean, for us it seems natural to be trading today, and I think that's the most normal thing to be doing, but it's amazing to think that 15 years ago this was totally impossible, that today we're already at 300 billion a day, traded by independent traders like ourselves. It's pretty much 6 to 7% of the overall market, and it is growing at something like 15 to 20% a year, and much more in emerging markets like China. So much so that one of our investors who regularly speaks to big shots in the industry was told the other day by Jill Mandelsis, who's the CEO of ICAP, and well, actually formerly with ICAP and now CEO of EBS. And he was saying that if trends continue at this pace, it is not unthinkable that, say, within 10, 20 years, retail flows, as they call us, I prefer to use the word independent because, our wallet might be retail, we have a little capital, but we're as smart, if not smarter than the big guys, so that's why I used independent, that we could make up to 50% of all flows in the future. So understanding this is a more and more important question. So let's go for the alphabet soup. Okay, now let's get going. As I mentioned before, currencies are traded over the counter, OTC, and as an independent trader, you have a choice to place your orders with essentially 3 types of brokerages. The first type is a pure dealing desk broker on the left-hand side, which I'll explain in a second. The second type is a pure straight through processing broker, which passes on all the risk to the market. And in the middle, you have the large majority of brokers. I would say more than 90% of brokers operate a hybrid model, whereby they selectively either operate a dealing desk or pass the orders on a straight-through processing basis. Okay, so as I said, if you have any questions whatsoever, please interrupt us as we go along. It's very, very important that I don't lose any of the process. So let's start with the pure dealing desk model, which was essentially the only possible model in 2005, which is when MetaTrader 4 was invented. Okay, it is actually a model that we should all be very, very grateful to because it created retail trading. Before that, it was just impossible for you to place a $10,000 nominal trade in the currency market, and this invention made it possible. So how does a dealing desk work? Well, essentially, there's a feed that comes from the interbank market, which is the price at which the banks are now, on average, trading between themselves. This feed is informed to generally your MetaTrader 4 dealer, who knows right now at what price the euro-dollar is trading. And then that dealer chooses to publish a price feed, which is what you see on your MetaTrader 4 terminal. And then you, of course, have a choice to trade or not to trade at that feed at any point in time. The important thing to say is that in this model, the market price feed that the broker is receiving and the price feed that you receive do not necessarily need to be the same. It could be that the spreads, there's a difference in spread, and there might even be differences in the mid-market price depending on how the dealer and the broker is positioned. In terms of trading, so whenever you go long the euro dollar, the only thing that's happening is that the broker is going short the euro dollar. So in that sense, there's a zero-sum net position whereby you benefit if the euro dollar goes up, and the dealer and the broker benefits if it goes down. Importantly, this trade has never really reached the market. All that's happened here is a bilateral agreement between you as a trader and your broker, who has just taken on some risk on your behalf. So let's go for the other extreme of the models, the pure 100% straight-through processing model, which was not possible in 2005, as I said, because back then technology didn't allow it for retail trade price sizes of as small as we're used to be processed, but is now increasingly possible for increasingly smaller amounts. If you think of, for instance, LMAX, which is the counterparty from which Darwinex sources liquidity, allows you to place trades for as little as 1,000 euros of nominal in the base currency. And actually the costs are even dropping at speed. What happens there, it's a slightly different setup in which there is a price feed that comes from the market. The STP broker may pass that same price feed or slightly alter it. Quite often some brokers do introduce a markup that amplifies the market spread. And then you choose to trade. And whenever you go long the euro dollar, then the STP broker is acting as the intermediary between you and the market by initially going short the euro dollar and simultaneously placing exactly the same order going long the euro dollar with the liquidity provider, so that the broker does not take any risk. Actually, going back a second, I've already misused the terminology myself. I said that a dealing desk broker, which is the first we discussed, is actually a broker, but that is a complete misnomer. It is not a broker, it is a dealer. And I will make sure that I change this presentation going forward. So the first model we've discussed is a dealer. They call themselves brokers, but that's actually a misnomer. They are dealers. So we were talking about the straight-through processing model now, and this is a broker because it is a pure intermediary that is standing in between the customer, i.e. you, and the market. It may or may not make a difference in terms of the prices you see. As we'll see later, there are things that you should know in terms of the incentives that brokers and dealers have. But very importantly, when you trade with an STP broker, you're actually trading with the market. Your trade has reached the interbank market, whereas in the case of a dealer, the trade has actually stayed in the dealer's book. Think of it as, if you think of the market like the ocean, you can think of the dealer's book like an aquarium. So if you're trading with a dealer, you're staying in a self-contained market. If you're trading with an STP broker, your liquidity is actually reaching the overall market. To give you an idea of how much or what percentage of brokers operates what model, there are no exact figures out there, but it is estimated by the likes of LeapRate that out of the 300 billion of nominal that are traded daily by independent traders like us, it is estimated that 150, which is about 50%, actually stays with the dealers and never reaches the market. It is flow that is being internalized. And I'll explain to you later what implications that has. So when it comes to STP, there are two flavors to it. Essentially, there's which depend on. Okay, good question. So whenever whenever a trader is going long the euro dollar, the STP broker is neither long nor short. He's actually taking two opposite trades at the same time, which basically means he's taking himself out of the equation. An STP broker never takes any risk. He doesn't go long or short. And what happens is that he's taking your order for going short with you for the euro dollar, and then he's going long the euro dollar with a market, so that net both average out. Does that answer your question? Okay, I think I missed someone there. Essentially, the very important thing to say is that an STP broker is neither short nor long. All he is doing is acting as an intermediary that sources liquidity, but it never takes any risk. It never goes long or short. The trade is essentially, you can think of the trade jumping the STP broker and going straight to the market. So when it comes to STP brokers, or straight through processing brokers, which process your trade straight to the market, there are two flavors of market where that your trade is landing. It could be that your STP broker is connected to an ECN, an electronic communications network, which is basically the best price that you can get on the bid and on the ask from all the different banks that are providing liquidity to that network. And in that situation, what happens is that there's an aggregation engine, which is getting the best price available and producing an ECN price feed that then reaches your STP broker. And that's then fed to you and you choose to trade or not. That's the so-called ECN model. And when it comes to the DMA model, the direct market access model, for instance, the one that LMAX in London use, which is one of the first exchanges for currencies, what happens there is that there is a single price that is the result of all the participants that contribute to, that trade on that market, be they traders like yourselves, or liquidity providers, or hedge funds, or companies, and so on. So that direct market access price feed gets to the broker. And then, unlike many of the other models, we publish the exact same feed that we're actually getting from the market. So the price that we get is the one that we offer you in the case of a DMA STP broker like DarwinX, which is the one we operate. There are a few other brokers that do this, but it is seldom the case that people offer the raw spreads. And then again, in that situation, there's always a trade. You place a trade with the STP broker, and the STP broker places the exact same trade with the market, so that net, what's happening is that your trade is going straight away from your MT4 terminal to the market, and it's being crossed there. Okay, which brings us to the hybrid model. As I said, there are very few pure dealers and very few pure STP brokers. The large majority of brokers, they are what's called a hybrid model that operates a customer B book. So what is a B book? Well, whenever you go long the euro dollar, the broker, the dealer at the broker is going to make a choice. He could either act as a dealer and take the opposite of your trade, basically betting against you and going short the euro dollar, or he can place the same trade with the market, as we just discussed, going long the euro dollar and thus not taking any risk. So a B book can be managed at the trader level, in which case some traders are hedged and some are not. This is very important to specify. So if you have a trader that is making money consistently and you are a dealer, it's basically the same situation as whenever a casino has a poker player that always comes in and makes money consistently. In that situation, the casino learns over time that, say, Peter is a very good poker player, and what they do at the casino is to deny Peter access to the casino, because obviously they don't want to be losing on a consistent basis. What makes the Forex market different is that there's so to say, a super casino, which you can think of as the market, and then the broker has a choice, an additional choice to the poker casino, which is to say, okay, well, given that my trader Peter is always winning, and I don't want to be at the other end of Peter's trades because then I would be always losing, what I do is I pass on Peter's trades to the market so that it's actually the market that loses against Peter and not me. In a reverse situation, if a broker, which they know because they have access to your trading history and they have algorithms to decide whether you're a consistent winner or not, they can say, well, if John is losing consistently, well, why would I pass on John's risk to the market if I know that John's money is going to be lost? What is B? Okay. Very good question. Why it's called a B book? Well, it goes back to terminology. That the STP book is called the A book, which is what you do when you pass on the risk to the market. And the B book is, so to say, the alternative, where you actually choose to keep the risk internally. The B doesn't stand for anything. It's, so to say, the B book is the alternative to passing the risk to the market. It's actually keeping the risk in the broker. That's where it comes from. But the B doesn't stand for anything other than the alternative to A, which is the STP model. So as I was saying, there's two possibilities. There are traders who make money systematically, and what a dealer would do would be to pass on the risk to the market so that he's not the losing end. When contrarily, if you know that John is losing systematically, then the brokers are smart and they say, hey, if John is going to lose all his deposit long term, then basically all I do is I trade against John until at some point he wipes out his deposit. And what really is happening there is that John's money is growing from John's pocket to the dealer's pocket. In between those two situations, what you have is, say, a typical setup, which is also good for a dealer, where a lot of the customers are actually trading in opposite directions. So it could be that kind of John is going long the euro dollar, and at the same time, Peter, in this example, goes short the euro dollar. And that's actually a great situation for the broker to have, because the risk between John and Peter is averaging out. The broker is not taking any risk, which means he doesn't need any capital to kind of withstand whatever losses he might have. And he is pocketing the spread, which is the best situation for him. Which brings us to the other way of managing the B book. So the B book could be managed at the trader level, whereby you choose that all the trades by John will be hedged or they will be taken on the B book. Or alternatively, what the bigger brokers and smarter brokers do is to say, well, I am going to take on the risk at a portfolio level. And whenever I'm taking too much risk, whenever, for instance, all my customers at the same time are going long the euro dollar, what I do then, if that exceeds my appetite for risk, is to actually pass on that to the market. And meanwhile, if in low volatility conditions, for instance, I will systematically keep the risk in my books without hedging, because hedging is a cost to those brokers. Okay, so now, very importantly, I think we've covered the topics that we had advertised on the alphabet soup. So, question here. Okay, so which companies are? Let me just see. This question of which companies are DMA and which companies are a dealing desk and so on. So that is something that you can, for regulated brokers, you can figure that out by going to the regulator's register and checking what permissions they have. And in a second, I will cover how you would do that for a broker located in the European Union. For instance, one example is of a DMA broker is Darwinex. We are a pure broker that never, period, trades against customers. But I'll give you, I'll show you how to find out if your broker is DMA or a dealing desk. But before that, I should say, what you should be paying attention to. First thing is that the technology has come far. So FXCM, I think FXCM is an STP broker, to the best of my knowledge. But as I said, I think the best way to check is to go to their regulator's website. And actually, Linda, coming back to your question, it may be that FXCM is different brokers to different customers. So it could be that they choose to be an STP broker for ECN accounts or DMA for ECN accounts, and that they are market making with other accounts. That's something that you should check with them. So as I said, the dealing desk model, which has come under a lot of fire lately, is it is fraught with conflict, of course, because at the end of the day, whenever the traders win, if they are dealing against them, on average they lose. So there's a conflict of interest there. But you should always bear in mind that there is no market at all times for all asset classes. For instance, there are the less liquid pairs. There's not so much active trading, so that sometimes a dealing desk can do a favor by taking on risk into their books and lowering the spread, for instance, during news and so on. And depending on the trading style, it could be that, you know, if you're a news trader, you're very likely to be better served by a dealing desk broker because they tend to keep the spreads constant at all times. And for instance, during news releases, when there's very little volatility, the spreads in a DMA market may widen significantly. And in that situation, you might prefer to stick with a broker that offers you a fixed spread. So as I was saying, you know, this is the point I was covering before. Very importantly, what matters more about the dealing desk is the situation whether the broker is hedging at a trader level or at the portfolio level. The biggest problem with a dealing desk is whenever they are hedging at the trader level. For instance, let me give you an example. Let's say you are a developer of execution algorithms or EAs, and you have been calibrating your execution advisor on the price feed from your broker, who's a dealing desk. And basically, you know, you go ahead, you optimize, you come up with a winning algorithm, then you put it to trade on real. And then initially, everything seems to be going pretty well. What type of the spread betting companies are? Well, again, most spread betting companies are dealing desks, most of them. But again, you would have to check with the individual company itself. So as I was saying, let's say you're an execution advisor, you build those algorithms, and you've polished your algorithms to get to make profits. Then you activate them and put them to trade on real. The first month goes very well, and all of a sudden you start seeing that your algorithm stops working, and you just don't get it because the price feed that you're using to optimize it is still the same, but the execution doesn't go through. Well, very likely what could have happened to you there is that your broker is a hybrid broker. Initially, they have put you on the B book, and you have optimized an algorithm which is winning against the dealer. The dealer has realized that you're making money from them. They put you on the A book, which all of a sudden changes the execution conditions completely. And you find yourself that the algorithm that you had been working on for so long actually is worthless because it was basically winning in an artificial market, which is the market that the dealing desk is producing. So in that situation, you really want to watch out because the brokers that do hedge on a trader level are pretty much always bad for you. So in the ECN model, who takes the opposite trade? Okay, that's a very good question. In the ECN model, the opposite trade is being taken by a bank who will not know who you are. And you should understand that the model for banks, the execution speeds vary. Okay, so let me take the first question is who takes the opposite trade in an ECN model? As I said, it could be the pool of banks that is contributing to the liquidity. Let's say, for instance, in the case of LMAX, which is our liquidity provider, there are 11 banks in there and they all contribute liquidity. And whenever one of the bank, you know, let's say Goldman Sachs is offering the most competitive bid, then it would be Goldman Sachs would be taking your trade. But then on your next trade, it could be that the most competitive ask when you get out of the trade is JP Morgan. So, you know, the first leg would have been closed with Goldman Sachs and the second leg would have been closed with JP Morgan. And more importantly, which is crucial, neither JP Morgan nor Goldman Sachs can reverse engineer your strategy because they can't see who's at the other end of the trade. And this is very, very important because if they know that you're a winner and they can see that you're making money consistency, they could reverse engineer your trade. So in terms of execution speeds, do execution speeds vary between dealing desk and STP models? Yes, of course, they do, and let me tell you why. So the dealing desk model, all that's happening is that your trade is going from MetaTrader 4 terminal to the server of the broker, and you know that's as long as it takes to close the trade. And in the STP model, it is going a longer road. Having said that, the average latency that we experience with our DMA model via LMAX is something like 200 milliseconds, which is, well, pretty much negligible from start to end of the process. Did that answer the question, Manuel? Okay, well, I hope it did. Okay, so now the things you should know with the dealing desk. Well, you should know that with a dealing desk, you're essentially trading, it's like trading with a casino, and it is possible that the house could blow. So if there's a very good trader that is taking a big trade against your broker, and your broker takes that trade, and that trade goes belly up for the broker, then the broker could blow up, and you could find yourself losing money even though you have nothing to do with that trade. So John trades against the dealing desk, it breaks the dealing desk, and all of a sudden Peter's money is gone along with John's. So if you're trading with a dealing desk, you should absolutely make sure that it is a regulated dealing desk, and it's preferably a big one, just like you would do with a casino. Why the trader segmented B book is wrong, I explained already. And there are things that you should be very, very, very careful with. This is where intellectual property comes in. So let's say you are a very good trader who's making money systematically on your strategy, and but actually you have very little money of your own pocket. So let's say you only have 10,000 euros in equity, and you're making 20% on a systematic basis on your 10,000 euros. And very importantly, you're doing so with a strategy that could manage up to, say, 50 million euros. So in that situation, you should always be aware that it is possible for someone to notice at the dealing desk that, oh, hey, this guy, he is making money on 20% with his 10,000 euros. How about I put in a couple of million of my own money, not his, to front run the strategy and basically make the same profits that he is making. Now, that is a situation which it's obviously illegal, but it is entirely possible for it to happen. So that, you should be very, very, very careful of who you trade with, because they could be stealing your intellectual property. This is crucial that you keep that in mind. And last but not least, you should always know that if your strategy and your equity and your trades are big relative to the dealing desk, you will run into problems. Because beyond a certain size, what will happen is what I discussed before, is that the broker will actually pass your trades to the market, and you will see that the prices at which you're trading and the behavior of the market that you're experiencing is changing. How can one avoid dealing desk front running? It's a very good question. It's by not trading with dealing desk. That's the best way to avoid it. In that situation, I would really recommend trading with could a non-dealing desk front run a trader strategy as well? In theory, well, not unless they breach the law. So they could not, no. And this is very important. That's why a non-dealing desk, if you are a very good trader and you're trading liquid pairs, I think it's a no-brainer that non-dealing desk is the way to go. And by non-dealing desk, I mean pure non-dealing desk, like Darwin's, like we are. Because that's the setup that's going to protect your intellectual property the most. So as I was saying, the strategy big relative to the dealing desk is going to run into problems, for instance, in social trading sites and so on. If all of a sudden you find yourself being tracked by a lot of people, you'll see that you'll start moving the market, because the market is actually your dealing desk, and there's not too much liquidity there as there is in the broader market. So as I was saying, so last but not least, please, if you've already been trading for a while, do a bit of due diligence and check the regulation of your broker. I've now explained more or less what the incentives are and what the issues are there, but please do make sure that your broker is regulated. When I say regulated, it should be in a respected jurisdiction, for instance, like the Financial Conduct Authority in the UK, or at least a European jurisdiction, because there you know that the regulator will be protecting you from all the stuff, the nasty stuff that I was saying before. If you choose to trade with a New Zealand registered broker or a British Virgin Island registered broker, I think that's actually not a very smart choice, because you're not really saving any money whatsoever, and you're going into all sorts of risks, which, you know, for which there's no need. It's actually quite stupid to do that. So it's, you know, I just don't understand why traders do it. Sorry. So, any questions that you have up to now? Okay, seems like we're doing all right. So issues to bear in mind with a dealing desk, and particularly with MetaTrader 4. So MetaTrader 4 as a dealer platform, it can be operated very honestly, but there's also all sorts of tricks that you can play against customers, and you should be wary of who you trade with on MT4, because they, you know, as I said, it's a platform which is open to abuse. So stuff that can happen. It's a classic is a requote, where you were hoping to trade at one price because that's what the dealer offered you. Yeah. Okay. So SISEC regulation. There's always a question of taste as to whether, you know, Cyprus is good or bad. I personally have big issues with a jurisdiction where the deposits of customers in Cyprus 3 years ago were confiscated. So, you know, 3 years ago, Cyprus went belly up, and people who had their deposits in a Cyprus bank all of a sudden saw that if they had more than certain money, then 10% of the money was essentially confiscated because the bank had gone bankrupt. So Cyprus regulation, well, in theory, it's the same as the FCA in the UK, but in some areas it's slightly laxer. And above all, you're trading with in Cyprus, which is a separate country, where, for instance, the deposit protection is nowhere close to as good as the deposit protection in the UK. So if I had to put my personal money somewhere, I would, if given the choice, always take hands down FCA in the UK, or, you know, any solid European country, if only for the reason that if the bank that your money is held in goes bust in the UK, you will get the deposit guarantee. And in Cyprus, in theory, you do, but 3 years ago, the banks went bust and you never got the money back. So, yeah. And the reason that many brokers are regulated in SISEC is, well, quite frankly, I think it's because some people like to take shortcuts, and it's easier in one place than it is in others. So, you know, as I said, I don't trade with Cyprus brokers. Okay. So issues that you can have on MT4 if you're trading on a dealing desk, it's a requotes, as I was saying. Then there's asymmetric slippage. So it could be that you send your order and the market moves one way or it moves another way. So what happens, and for instance, a big broker like FXCM was fined for doing this 4 years ago. If the market moved for customers, and the customers traded at the quoted price, i.e. they did not benefit from the market move. If the market moved against customers, then of course the customers lost because of the movement. So that's asymmetric slippage, and that is a very bad thing to be doing, that for which, for instance, FXCM got fined a couple of millions some months ago for stuff they had been doing in 2010. But the most dangerous thing from MetaTrader 4 is different customer groups. So in MT4, there is not one single market price that, okay, so do FCA protect the local or also foreign trading money? Yes, okay, so yes, this is very important. The FCA for British banks does protect money from anyone wherever they are in the world. So for instance, if you deposit your money with DarwinX, it will be held with Barclays in London. And if Barclays should go bust, then the deposit protection scheme will apply so that you will get your money back up to 75, I think it's actually £85,000 now. So yes, they do protect foreign trader money. And in the UK, think about it, it's one of the most important things to them is reputation. And because that's all they live by. So the UK would think about it a lot before defaulting on deposits from foreign depositors. So, as I said, I think whichever broker, but FCA is probably one of the best regulations out there. Of course, depending on where you live. In my personal opinion, FCA is the best in Europe. If you live in Asia Pacific, Australian regulation is about the safest you can get, but it depends for where you live and what your preferences are. So, but what I was saying on the groups, and this is a critical thing to bear in mind, is that a broker can have at the very same time a different price on the euro dollar for one customer group, one customer, than it can have for another customer. And for instance, some dodgy brokers, what they do is they know traders that trade with stop losses. So what they basically do is they can run the stops and make the price feed a bit more volatile so that your stop is hit and you trade at the stop level, and then boom, the price goes back and you've locked in the loss. So that's, you know, a nasty one to watch out for. Another nasty one is a group reallocation, as they were saying. So you could be, when you start with your execution advisor, the broker still doesn't know that you're going to make money, so you're still on the B book. And whenever they realize that you're making money, they put you on the A book. All of a sudden, the price feed has changed, and your execution advisor stops working. So you've wasted a lot of time in polishing an execution advisor for pretty much nothing. The other issue, as I was saying, is the front running, the risk of front running. The problem with PAM accounts, how can you tell if you're getting a different price? Okay, that's I think, quite frankly, you should just go to a broker that only has one price and do that. So in our case, at Darwin's case, the best way to check is you can take our MT4 download, check the price that you're getting from us, and then you can go to the site of LMAX. So you could, in our case, you could check lmax.com, whatever price they are. Sorry, let me send to all participants. So with us, you can download your RMT4 and check the price on RMT4. And you can check the price at lmax.com, and you will see that at all times they are exactly the same for all the customers at all times. So that's one way to look at it. I think the best way to do it is by choosing a broker that you can trust, not to do the different prices for different users. So what amount of stop is it safe to not to be stop run? Again, I think the best way to solve that question is not to have different amounts of stop. I think it's actually a way to choose a broker that is not a dealing desk, because the last thing a non-dealing desk broker would do is to run the stops. They are essentially passing you on the price of the market, and they're not playing with the price. The big problem with a dealing desk is that you're not trading against the market price, you're trading against the price of your dealing desk, which may or may not be the same as the market price. So FX Bookie, the best solution, I think, is to choose a broker that will not run the stops, rather than put the stops far away or whatever. Yeah, and then last but not least, if you're hoping to manage investor capital, you should, by far, the best choice is to go for a non-dealing desk straight away, because if you start optimizing your execution advisor on the true market price, then as you scale your volumes, you will see that things do not change. If you're growing in a dealing desk, then you'll see that you're much likelier to get into problems much faster with a dealing desk. Having said that, if you're only running your own money and there's nothing better than a stupid dealing desk, because you could be making money from them, and that's essentially what scalping is. So scalping really is a way to get money from dealers who are not very smart about how they set their own prices. So before, I don't know who asked the question of how to tell if the broker was a dealing desk or a non-dealing desk. With FCA regulation, you can go to the permission site of your broker, and these are the permissions that apply in each of the cases. So a broker that is dealing in investments as agent is a non-dealing desk. Safeguarding it's a permission you have to be a broker, so basically to hold the customer money, so ignore this, what I mean. But basically, these are the two alternatives. So the pure STP will either just have the permission of dealing in investments as agent, but not dealing in investments as principal. And it could also be like the case with Darwinix, as I'll just say in a second. For instance, we have both permissions. So we have the permission to act as an agent and to act as a principal, but we have a restriction, which is the matched principal restriction, whereby we are forced by law and supervised by the FCA to always take basically opposite trades from both sides and never take risk against customers. So it's the same as being 100% STP. And that was pretty much it. So I don't know if you still had any outstanding questions. I'm not sure I've managed to clarify everything, but if you have any questions which I haven't managed to answer up to now, I would be very, very happy to take them offline at my personal email address at juan@darwinx.com. Or I'm very happy also to chat to you bilaterally via Skype through Juan Colombolea. And that was pretty much it. So thank you guys, and see you around for the next webinar.